Greetings traders, and welcome back to another survival guide. Chris here, bringing you some more information, and today that information will come in the form of what is technical analysis and why should I care? That is the gist of what we'll be talking about today, and at the core of trading, you probably are already aware that most of us like to make decisions. At least we like to think we're making informed decisions, and one of the trains of thought that lead traders to making informed decisions is technical analysis. You have technical analysis and you have fundamental analysis. So today we're going to talk about the technical analysis side of things so you have a better understanding of exactly what it is, as well as some examples of technical analysis along the way. We'll look at some charts and all that good stuff. So hopefully you'll be better suited for when you go take that Gauntlet Mini and finally see if you have what it takes to pass. But let's get going. There are many different forms of technical analysis, and you'll find throughout your trading career that it's actually very common for traders to overlap various forms of technical analysis to attempt to further confirm whatever information that they're pulling out of the market. They're trying to further confirm the accuracy and the validity of whatever read that their technical analysis is telling them. So at the core of what technical analysis is, let's cover the definition. By definition, it is something that can be described as the process of attempting to predict future price movements by analyzing historical data, such as price path and volume. These are the two main things that are generally analyzed when traders say that they're using technical analysis to get a better idea of where something might be going. Technical analysis is the art of looking at the past and getting an idea of how the future might respond when those similar circumstances are then presented again. Over the years, there has been a constant debate on technical analysis versus fundamental analysis. Many traders have conflicting opinions on which one is more productive and which one we should spend more of our time refining our skills in. Now, let's start back in time with Munehisa Hama. This is the beginning of technical analysis in most people's eyes. This goes as far back as the 18th century, where Japanese traders were using technical analysis to invest in different assets. And one of the leading individuals paving the way in this type of investing was Munehisa Hama. He created what is now known as Sakata charts. These are perhaps best known in most people's eyes as just simple Japanese candlestick charts. Then we have Charles Dow. Charles Dow is perhaps best known for creating the Dow Jones Industrial Average. Perhaps you've heard of it. Dow created the foundations for modern-day technical analysis. He used historical data from the index, and he would regularly write articles identifying the emergences of various trends that were existing with the prices of those particular indexes. Then we had William P. Hamilton. William P. Hamilton was a trailblazer who used the concept of the Dow theory. He added new rules to create an unnervingly accurate predictions for his time. He was the first to identify the concept of the 4-year long-term trend, incorporating short-term waves which could potentially last for days, weeks, or even months. This was new at the time. While there was little premature predicting that 1929 crash that occurred, William P. Hamilton arguably knew that 3 days before the crash, he was expecting it to happen, or at least the story goes. Then we have Robert Rea. Now, you'll know that Robert is someone who took the theory, if you do some research on him, and essentially, instead of developing his own completely unique ideas, he enhanced ideas that already existed in the technical analysis space. He was described as being one of the first market movers. He made most of his wealth through subscription investment letters, but his investment skills were renowned nonetheless, and he has made the board. Then we had Edison Gold, and Edison Gold came along, and he was arguably the most successful long-term trader in technical analysis even back in the 1930s, when technical analysis really wasn't all that prevalent. He was very popularized with his ability to accurately trade the DJIA at the time, going back to our old friend Charles Dow. And then finally, we have John Magee, and this is back in the age of 1948, around World War II, when John Magee was rewriting the technical analysis book. That's where we find him on our timeline, so to speak. And he wrote a book called The Technical Analysis of Stock Trends. This was a book that was really the first book that ever came out that was solely devoted to technical analysis and trying to help others better understand the techniques in which he was using. The concept of technical analysis can be broken down into three main principles. The first one is that markets discount everything. As we've talked about in the past, the best way to view securities markets is simply just an information exchange that is happening. It will reflect what the public information and non-public information is doing, and as such, it is representing this by showing you which way people are buying by which way price is going, as well as analyzing volume. A popular way to describe this phenomenon is to say that all these factors are just priced into the market. In theory, price tells us everything we need to know. Therefore, monitoring the price and volume should give us an idea of future trends. Then we have the second principle, which is market inertia. Swapping the term inertia for the word trend might make this concept a little bit more recognizable. There is an old saying amongst us traders that is, the trend is your friend. Whether it's rising, falling, or trending sideways, if we're riding in direction of the trend, chances are we're already on the winning edge of the coin. This is an especially important concept to pay attention to because this is, at its core, technical analysis. If we're analyzing which way price has been going and is currently going, and we're using that to decide where price will go, that is technical analysis. Then we have the third principle, which is markets move in waves. Whether looking at short, medium, or long-term trends, you will notice various instances of overbought and oversold markets while analyzing pretty much any asset. The analogy that markets move in waves is relatively apt, but for example, if a company makes a major announcement, it may prompt buyers and sellers to all of a sudden emerge. It's like how dropping a stone into a flat plane of water will prompt ripples that are just going to work its way outwards as this new effect is factored in. The idea of using waves as an analogy for technical analysis is a bit of an interesting one, but it does suit the phenomenon that is how markets move and what technical analysis is. Now that we know what technical analysis is, the understanding of why it helps should be readily apparent. The reason that technical analysis is just so valuable to a trader that masters it proficiently is because it further helps them understand the market movements that have happened in the past as well as those that will happen in the future. Then it also helps with discipline. By practicing technical analysis, you also have to practice discipline. By waiting for these particular events to happen again in the future, you're forcing yourself to resist the urge to trade, and this is a very positive attribute to build, especially in a world where patience is very important in a world of trading. Then we have the fact that identifying trend lines is always going to be a valuable aspect, and that is a core concept of technical analysis. Finding out which way the market is trending and paying attention to how much it's fluctuating as it trends can give us insight into where to buy and potentially where to sell. Then the other information that we gain from technical analysis is the fact that it'll allow us to adjust our targets based on the market conditions. This means that if we have a location set for a take profit, but we notice certain technical analysis information that is allowing us insight to see that the market might not actually reach our initial target and it might actually fall soon, we can use that information to close out our trade in the green instead of wait for our trade to close out on the stop loss. And also, trading on boxes is a thing. So this is a trading term, so you may not have heard of this one, but the concept is trading inside the correct box. Now, this references usually a period of consolidation or in a period of accumulation or distribution. Identifying which box phase that the market is in with technical analysis can make sure you're on the right side of what's to come. And then once again, patience is something that is more or less hand in hand with discipline, so we don't need to talk too much about that. But patience and discipline are both ideal traits to have as a trader. Support and resistance is a key aspect of technical analysis and represents one way that technical analysis can be done. The way this is done is by identifying areas in the market where there seems to be an invisible wall. Support is an area that price falls to but has a hard time trading below, and as such price usually pushes back up off of it. Resistance is an area that price rises to but has a hard time breaking above and trading above, and as such usually falls back below. It is common that when price finally does break above an area of resistance, if it does return from the top side now down back towards this area of resistance, it is common to see this now function as an area of support, sending price higher, just the same as if price falls through an area of support and works back up to the support from the underside. It is possible that that support will now function as resistance. Support and resistance is a very, very valuable skill that you will get better with over time, and when you master it completely, it can be more powerful than just about any other form of technical analysis. Channels is a word that's used to describe an area that price seems to be stuck in as it's trending upwards, downwards, or even technically sideways. Usually when traders use the word channel, there is a degree of an incline or decline in what's going on with price, and it represents an equidistant area of resistance and support that is holding a particular direction. So if the distance between these two lines is, say, I don't know, 10 points, just hypothetically speaking, the distance between all of the swing highs and lows that are occurring during this period of price should be no greater than that 10-point span to maintain the integrity of the channel. Channels work very similar to support and resistance, but they're just dynamic in their nature because they're moving upwards and downwards instead of just left and right. Here's another channel on the same chart, just shifted over a tad, and this is going to show that what happens when a channel is broken. So as a channel continues to show resistance and support, this is only going to last for so long. Obviously, nothing lasts forever in the world of trading and pretty much everything else. So when we finally fall out of the channel, this would be said to be a bearish event because we're falling through the floor, we're falling through the support, and we treat this just like any other type of support break. Now, the goal in this scenario is going to vary based on the particular scenario, but I always like to look for the most recent swing low that occurred before the channel began. In that case, it would be over here. So ultimately, if I was looking for a low target point for where price might be falling to before bouncing back up, I might have my eyes set around this 2717 area. But once again, this is another example of a channel where price is getting stuck between an area of resistance and an area of support for some time before ultimately breaking out. And when we break through the bottom side, we expect it to go down. When we break through the top side, we generally expect price to go up because we now have gained a very large increase in buying pressure if we're breaking through the top or selling pressure if we're breaking through the bottom. Another common form of technical analysis in chart identification patterns comes from the squeeze. Some traders know this as the wedge or the triangle formation. There's a lot of various forms of a squeezing formation that get categorized into a bunch of different subcategories, so to speak. The squeeze is going to be when you have something that looks essentially like a channel, but it's converging in on itself. That means that the distance between your area of resistance and your area of support is continuously tightening to a point. It is also possible it could be doing the opposite. It could actually be widening like a megaphone as well. There are various forms of this, but once again, the squeeze is going to reference when price is squeezing closer and closer together, and usually what happens when price has really no more room to squeeze together because it has gotten so tight between the area of resistance and support, ultimately that is when we are on our highest opportunity to find a breakout, generally speaking, because price really has nowhere else to go besides break. This chart represents what happens when price flips through one of these areas that we're talking about, whether it be a channel or an area of support or resistance. The concept is if we have an area that is holding price above it, and that is the least straight line I've ever drawn, but if we have an area that is holding price above it like we did here where price was constantly supported by this particular angle here, not perfectly, but general idea is quite steady, showing a certain degree of increase. When we finally fall through it, as we did right here, what ended up happening was this area ended up becoming a target for buyers to push price back too, but the sellers now use this as their backbone to keep pushing price down. It's the flip that occurs between price staying on top of a level and price falling through a level. As far as technical analysis indicators go, there are a ton of them. There's no way that we could list all of the indicators because this video would be entirely too long and you wouldn't watch it and I really wouldn't watch it either. So if you're looking for technical analysis indicators, I'll name some of the most common ones for you. You have Bollinger Bands, you have moving averages, both exponential and simple. You have MACD, which stands for Moving Average Convergence Divergence. You have the Money Flow Index, you have the Arun Indicator. The list goes on and on. How could we forget the Relative Strength Index? There's various oscillators out there. It is a very, very deep pool that you can choose from if you're looking to play around with some technical analysis indicators to help you better understand what's going on in the market. But thank you for joining me as always, folks. I wish you the best of luck in the market out there. Stay safe, good luck, and happy trading. Bzz.